Welcome to podcast number 2, Market Psychology, with Moimir Hlinka. You are director of the Zurich asset management company AgFIF International. In the first podcast, we talked about the depression in the markets. The depression actually deepened. There have been some dramatic events that have also had an impact on market developments.
Yes, hello Peter. I welcome our viewers to the second podcast. Yes, since our last conversation, the situation has worsened massively in the last few weeks to the extent that we have a new source of fire or conflict due to Israel's cruel declaration of attack in retaliation against Hamas. Of course, that completely threw the markets off track. We'll get into exactly that later. We saw a muted response immediately after this attack over the weekend, on the Monday after this weekend too. Also on Tuesday, but in the following days, the situation naturally worsened massively. There was a small sell-off globally. This has now been put into perspective again, both in many sectors and also geopolitically. That means America has recovered much better than Europe. The markets are cold and unfeeling, but the investors are not. We have clearly seen that the markets are primarily interested in this conflict, that it remains a temporary conflict, that an escalation is avoided, and above all, what effects this has on energy sources, especially on the price of oil.
It is interesting that the US Federal Reserve has imposed a freeze on interest rate increases, and it also triggered a positive reaction in the market. This actually compensated for the Middle East conflict.
There was a pause in interest rates worldwide. I find it particularly interesting when it comes to the Fed because the situation in the USA is special, because the interest rates are significantly higher than here in Switzerland, even higher than in Europe. Jerome Powell, head of the US Federal Reserve, acted very prudently. I welcome this interest rate break because an interest rate increase or cut takes months to have an impact on the markets. This can take up to 3 months. The last interest rate hikes have not yet reached the market or been anticipated. That's why this interest rate break is absolutely right. And interest rates are at a level that gives massive scope for further interest rate cuts in the coming year, which can slowly be deduced from the longer yields.
The fact is, and you said it, the markets are cold. This is another reaction and influence on market behavior and on the Middle East conflict. The markets are pulling back. If I take the view of a customer or your view of the customers or the customer portfolios, which market psychological mistakes do customers make the most in such a situation?
Of course, the biggest mistakes you can make are the following mistakes. I would like to separate 3 wrongdoings. The biggest misbehavior, which is probably known to every viewer, is the herd instinct. When the herd runs, you run in the same direction because it is always easier to join a group than to impose your own opinion. We don't have that at the moment, like a classic sale. I completely agree with you. The second case of misconduct is a little different. I explained these 2 misbehaviors, the disposition effect and the availability misbehavior, in the last podcast. The availability of certain information and the disposition effect are very similar and go hand in hand. In market psychology, the disposition effect means that investors process profits and losses differently. Gains bring less joy than losses cause pain. This creates an asymmetry in our behavior, and that is exactly the situation in the market. If you look at the situation, it's clear that the markets have fallen and you're getting scared. You may even panic. This is the worst advice, and you tend to sell everything no matter what, precisely because of the pain of the losses you have incurred. I don't act selectively under pressure. Above all, the market dictates, not my own objectives and preferences. It is important to take irrationality into account and distinguish between quantity and quality.
When I see this in myself as a classic customer who has little knowledge and looks at my portfolio, it contains stocks that have been running for several years and I have never sold. There are some portfolio corpses that I carry with me and that I don't sell because it doesn't hurt me. On the other hand, I say, the markets are somehow very complicated at the moment, and I still made a few good profits. So I'm selling these titles. That would be a classic mistake and misconduct if I understood correctly.
That's just like I said, these two biases go hand in hand. What you just mentioned is the disposition effect, and this means that investors tend to realize profits too early and suppress losses. Why is that? We talked about how losses bring more pain than gains. A realized profit brings us more joy than a book profit. On the other hand, a realized loss causes us more pain than a book loss that we like to suppress. That is the disposition effect. That's exactly the point you made. There is a tendency to suppress book profits and reward yourself with profits. A classic example of this is as follows. We turn the clock back 10 years. We only have two stocks in our portfolio, UBS and Apple shares. Since then, UBS has lost 80%, while Apple has increased about 14-fold since then. I imagine you would basically succumb to this effect, and you would have said to yourself, oh, now I have, after a year later. You say to yourself, now I have the upper one. I say the UBS for half the price. I can buy UBS, but my Apple shares had doubled. Now I reward myself and take the profits with me. I'll put this in the UBS share, then the disaster would of course be perfect. This is a classic example with two stocks that everyone knows. This shows the power and danger that arise from the disposition effect or lurk within it.
AgFIF works with a specific algorithm that records this disposition effect and transfers it to market events. Can you explain that?
That's absolutely true. This algorithm helps us decide not what the returns are that the market is giving, but how the returns are subjectively perceived. We will do a podcast just about this algorithm because the topic is beyond the scope here, so that every new viewer can best familiarize themselves with this topic, which is what this algorithm does. The algorithm does nothing other than tell us, decide fundamentally, but don't decide based on market psychology. This is a great help, which is of course worth its weight in gold in such situations.
From the findings of market psychology, from misconduct or the herd instinct, can you also benefit from this?
Absolutely right. That's what I said. This algorithm does not show us what returns the market originally delivers, but rather how these returns are perceived by investors. This is a huge difference, which, as I said, offers opportunities and also presents clear risks.
Regarding availability bias, how do I properly inform that I can make truly rational, objective decisions?
A very good question. Please imagine that you have 100 newspapers that write about a certain topic and you want to buy Apple shares, for example, just as an example, because everyone now knows Apple shares. Since I can't buy all the newspapers, I only buy 5 newspapers. In these 5 newspapers, there was not even anything positive written about Apple shares, and 4 times something negative was written about Apple shares. What am I doing? I am very positive, but I have only read 4 out of 100 opinions or newspapers. The other 90 newspapers may say the opposite. That's exactly when I have the problem. This means that it is important to rely on the rationality of the information. The information I absorb is always moment-related. Only to filter out the factuality of the information for myself and not the opinions of third parties, and certainly not any third-party advice, but to actually limit myself to the essence and the information content.
It means that once you have decided on an investment strategy that is tailored to your own personal financial needs and circumstances, you should stick with it. The availability bias is the greatest danger.
Undisputed, I can absolutely underline that. Once you have agreed on your personal risk profile and your strategy, which of course needs to be carefully evaluated for each customer, you should remain true to this strategy. That's the absolute A&O. This is the basis for long-term success. Otherwise, there is a risk of failure and you will end up in the danger zone if you start changing the profiles. This is the sure way to lose money.
Because you trade too much and pay fees more than you actually gain in returns.
That's additional.
Let's talk about the herd instinct. Actually, if you can formulate the herd instinct positively, that means I'm riding a wave and using the momentum in a stock that's rising and you want to be part of it. There's nothing wrong with that.
That's great the way you said it. The problem is that you never know when that wave will start to build. You don't know when this wave will break either. You don't know that. Therefore, wanting to ride these waves would be pure luck. We are not soldiers of fortune and therefore not riders of fortune. Rather, we are someone who pursues strategies over the long term and implements them very carefully and relies as little as possible on luck, whatever is involved. But luck should play as little of a role as possible.
Let's look at the last 8 weeks of the year. What will happen?
I stand by my statement. The markets are depressed, but they won't stay that way. That was the statement from the last podcast. Now the catastrophe in the Middle East has occurred. I repeat my statement that the markets may be a little more depressed, but they won't stay that way.
Thank you for this interesting information.
Thank you.